Right now, somewhere in America, a retiree is checking their brokerage account, feeling proud because they own a stock, paying an 8% dividend yield. They think they found the secret. They think they're set for life. They're wrong. And in the next few minutes, I'm going to show you exactly why that safe 8% dividend is often a trap, and why almost everything you've been told about dividend investing is either outdated, oversimplified, or just plain false. If you own dividend stocks, are thinking about buying some, or you've ever heard someone say, "Just live off the dividends, stay with me," this is going to change how you look at your portfolio. Dividend investing has this reputation. It's the safe strategy, the boring but reliable strategy, the one your uncle recommends at Thanksgiving. Buy stable companies, collect a check every quarter, retire comfortably, never touch the principal. It sounds great. It's also full of myths that can quietly wreck your financial plan if you don't understand what's actually happening under the hood. Today, we're breaking down the biggest misconceptions people have about dividend stocks. Not to tell you dividends are bad, but to help you actually understand what you're doing when you invest in them. Because there's a huge difference between investing with knowledge and investing on autopilot. Because that's what everyone says. Let's start with the myth that trips up more people than any other. Here's something a lot of new investors don't realize. A dividend yield isn't just a reward for owning a stock. It's a ratio. It's the annual dividend divided by the current share price. So think about what happens when a company is in trouble and its stock price crashes. The dividend payment might stay the same for a while, but because the price dropped, the yield goes up. Mathematically, automatically. That 8, 9, even 12% yield you see flashing on a stock screener? A lot of the time, that's not a gift. That's a warning sign. The market is pricing in the fact that this company probably can't sustain that dividend. Analysts call this a yield trap, and it catches people every single year, especially in sectors like energy, REITs, and telecom, where big payouts look tempting. A healthy, growing company usually has a modest yield, something in the 2 to 4% range, with room to increase it over time. A company yielding 10% plus is usually telling you a story, and it's rarely a happy one. This one sounds harmless, but it fundamentally misunderstands how markets work. When a company pays a dividend, the stock price drops by roughly that same amount on the payment date. That's not a coincidence. It's basic accounting. The company is literally handing you a slice of its cash, so its total value goes down by that exact slice. So if you own a stock worth $100 and it pays a $2 dividend, the stock is now worth roughly $98, plus you have $2 in cash. Your total position is still worth about $100. You didn't get free money. You converted equity into cash. This matters because a lot of people chase dividends thinking they're getting extra returns on top of stock appreciation. In reality, dividends are just one way a company returns value to shareholders, the other major way being share buybacks or simply reinvesting for growth. Neither is automatically better. It depends on the company, the tax situation, and your personal goals. This myth comes from a half-truth. Established, dividend-paying companies are often more mature and stable than speculative growth companies. That part is true. Mature companies tend to have steady cash flow, established markets, and less volatility day to day. But less volatile is not the same as safe. Dividend stocks can absolutely lose value, sometimes dramatically. Look at what happened to major banks in 2008, or energy companies during the oil crash, or even some blue-chip names during market-wide corrections. Owning a dividend stock doesn't insulate you from the price of the underlying business collapsing. And here's the part people really don't want to hear. Dividends can be cut. Companies are not obligated to keep paying them. When a business hits hard times, the dividend is often one of the first things reduced or eliminated entirely, right when investors are counting on that income the most. Automatic dividend reinvestment, often called DRIP, gets recommended as a default strategy. And for younger investors building wealth over decades, it can absolutely make sense. Compounding works. But treating it as a rule that never gets questioned is a mistake. If a stock is trading at an inflated price, blindly reinvesting means you're buying more shares at an expensive valuation just because that's what your brokerage does automatically. Sometimes it makes more sense to take the cash and either rebalance into something undervalued, or, if you're near or in retirement, actually use that income the way it was intended, to live on. The point isn't that reinvesting is wrong. It's that automatic and smart aren't always the same thing. This is the retirement myth, and it's probably the most dangerous one on this list. The idea is appealing. Build a portfolio big enough that dividends alone cover your living expenses, and you never have to sell a single share. Your nest egg stays intact forever. Here's the problem. The value of your shares still moves with the market, dividend or not. If you're heavily concentrated in high-yield stocks to maximize income, you're often taking on more risk, not less. Chasing yield frequently means chasing companies with shakier fundamentals, as we covered earlier. And if those companies cut their dividends during a downturn, which is exactly when downturns tend to happen, your income drops at the worst possible time, forcing you to sell shares anyway, at depressed prices. A more resilient approach that many financial professionals point to is looking at total return, combining dividend income with the possibility of selling some shares strategically, rather than treating dividend income as some magically protected, separate category of money. It isn't. It's still your money, still subject to market risk. So if yield isn't the goal, and dividends aren't free, and safety isn't guaranteed, what should you actually be looking at? A few things genuinely matter more than the yield number. First, the payout ratio. How much of the company's earnings are actually going toward the dividend? A company paying out 90% or more of its profits has very little cushion if earnings dip. Second, the track record of consistent or growing dividends over many years, sometimes called a dividend growth streak. Companies that have raised their dividend for 10, 20, even 50-plus consecutive years tend to have disciplined management and durable business models. That history says more than any single year's yield. Third, the overall financial health of the business, debt levels, cash flow, competitive position. A dividend is only as reliable as the company behind it. And fourth, your own diversification. No single stock, no matter how reliable it seems, should be the backbone of your entire retirement plan. Spreading across sectors and asset types protects you from the one thing every dividend investor eventually learns the hard way, that even safe companies can surprise you. None of this is a recommendation to buy or avoid any specific stock. It's simply a framework for thinking more critically the next time you see a big, shiny yield number and feel tempted to jump in. Dividend investing isn't wrong. It's a legitimate, time-tested strategy that has built real wealth for millions of people. But it only works when you understand what's actually happening. Not when you're chasing a number on a screen, because it feels like a shortcut to financial freedom. The truth is less flashy than the myth. Slow, steady, well-researched investing beats chasing the highest yield you can find, almost every single time. If this video helped you see dividend investing a little differently, that's exactly what it's here for. Hit that like button. It genuinely helps this channel reach more people who need to hear this. If you're new here, go ahead and subscribe, because we break down topics like this every single week. cutting through the noise to help you actually understand your money. And I want to know from you. Down in the comments, tell me, have you ever bought a stock just because the yield looked huge? What happened? Let's talk about it below. Thanks for watching, and I'll see you in the next one.